So here's where we normally go through the summary of what we're seeing. You can see that right now we're right in line with where we were in 2021. Obviously, there's lumpiness when you're looking at kind of the averages, but where we last week was 14.357 million barrels a day of demand. Week before that was about 13.996. So we should see kind of that natural movement higher when you start looking at weather improving, spring, and now we'll get one more, some of that nice spike when you start looking at it from the perspective of driving for spring and for spring break, Easter. But when you compare it to 2017, 18, and 19, you get an idea of just where the disconnect remains. Distillate continues to be an overhang when you start looking at the trucking market, how that has slowed and is going to kind of remain a bit of an overhang. But we will get that bounce in gasoline. We will see that bounce in jet fuel just for the week. And then the question is going to be, where do we settle down? Because typically we kind of see a little bit of a lull, and then you get that movement as we progress into into Memorial Day weekend, which is the official, unofficial start to the driving season. So again, that's where you normally kind of see that as you get into May. You can see that typically you get that bump in 17. We got it in 17 and 18. 19 was a little bit weaker, but what the key is to look at it in regards to the aggregate, especially when we start looking at the averages, where the averages continue to kind of drift lower, and it remains close to about 4.2 million barrels, again, right in line with that 2021, and we don't see that deviating too much. Now on the distillate front, you can see that we had a disti stock draw of 2.9 million. That's 23.6 million below the 5-year. A lot of that being driven by Pad 1, which had the drop of 15.5. Small build of 80,000 barrels. Again, that's going to be that shift with a little bit less trucking demand, no longer needing the same type of heating oil demand. So you'll see some of that pivot. Pad 2 and Pad 3 had draws of over 1 million barrels. Pad 3, we had a big increase in exports, and then Pad 2 was just because they're starting to adjust a bit on the refining front. Imports came back up, increased by about 66,000 barrels a day. That's only 16,000 below the 5-year average. We expect it to stay fairly in line just because Pad 1 does remain a very good spot to bring a lot of this product into. Now, when you start looking at yields, especially on the disti side, so yields were down by about a little over 1%. On the disti front, that's just because we had, again, that big drop in the activity level when we're talking about 2.5% less refinery utilization rate. That'll start to come back up. But when you look at storage, that's why we always like to kind of smooth things out and look at the average. You can see that typically this is where you start to flatline, bottom, and then get a gradual increase. We expect that to be the case, just the rate of change is going to remain a bit depressed and will stay fairly far away from that 29-year average, especially, and then taking away just the last 5 years, where the 5-year average is 23.6 million. So again, we're below by 23.6 million, obviously still being in a tough spot. Now, when you look at product demand, you can see that we were expecting to see a little bit of that kind of makeup number, if you will, and come back to that 5-year average. Instead, we had another steep drop. We will get a bounce. The question is going to be, now that we've come this far down, are we going to get an outsized move, or are we seeing enough degradation in the trucking market that any type of bounce is just going to take us back to the 5-year average? And right now, I would say that because of the degradation in shipping and in just trucking in general, the bounce, and which will happen, will just bring us back to that 5-year and bring us to about 4 million to 4.1 million barrels a day. So we will get that increase, but again, it's not going to be anything really strong. And then all of the leading indicators continue to point to a slowdown in trucking capacity, which is why when we start looking at what is happening here, you can see, if you remember, we said that we were going to kind of bounce and just stay between, let's call it, 120 to 130, 135, and instead we had a big drop down. We're now the lowest we've been since 2020. We came past that low from 2021. It's still elevated, zooming out, but all of the leading indicators are showing that, again, there's been that build in inventories. We're not seeing a really big demand to continue to pay these rates. So that's where we're seeing some of this slowdown. We see more of it coming through. We could get a quick bounce, but again, the trend is going to continue to come back and likely fall below 100 over the next week or two. Now, just using the Cass Freights Index, U.S. freight volume slowed further in March with the shipment component of the Cass Freight Index up just 0.6%, slower than the 3.6% year-over-year growth in February. Shipment components of the Cass Index rose 2.7% from Feb. This was 1% below the normal seasonal pattern. So it's not only just down based on what we're seeing, but it's also down versus seasonal norms. Year-over-year growth in shipments slowed to 0.4% from Q1 of 22, from 4.3% in Q4 and 9.5% in Q3, while a few points of softness in Q1 were due to Omicron-related, freight was slowing even before the war in Ukraine began. So again, the threat of this is something that Craig has talked about from Freight Waves, and now Cass is indicating. The threat of a freight recession has risen recently as services reopen, inflation presses up interest rates, and though war-related effects are likely to be modest in the near term, higher energy prices have an increasingly negative effect over time. So again, there's that view that we're coming into this steeper slowdown, which again is going to be a big impact on the U.S. diesel front. Now, U.S. rail traffic picked back up a bit. Total carloads were up 1.4%. A lot of that was driven based on, obviously, coal, forest products, grains remain strong. Motor vehicle, again, trying to kind of pick back up, kind of catch up with where things are. Petroleum products still remaining weak. And then intermodal bounced, but again, still 3.1% below last year. And remember, last year we had a lot of issues in terms of everything from chassis on down. So again, you're seeing an increase, but still seeing those pressure points on the rail front. When we look offshore, you can see that the volumes have dipped a bit. The prices have come down. Obviously, there's a bit of an issue on a supply chain coming from China. That's going to take time to show up. That isn't in these numbers yet. But you can see, obviously, we're down from last year, which was a very elevated level. But we're still high. We're still strong. There's still a lot of stuff coming through on both the East Coast and the West Coast, which is going to keep that freight moving internally. Now, this is where you see some of that shift, especially when you're looking at the demand for natural gas, for heating oil. Because we're in spring, even though we're below, it's not like we're going to be in freezing point. It's just we're going to be in that 40 to 55 range, which is kind of using a little bit of natural gas, using a little bit of heating oil, but just obviously we're not putting on the AC. It's just how much are we going to consume on the heating side. The other issue, this is going to impact some of the early plantings on the corn front, again, leading back to what we were discussing on corn acreage and yield. So this is going to be something that's going to impact the food front, as well as put a little bit of a bid that's remaining in some of the needs for heating oil. But we see this as kind of like the last hurrah, and then things will continue to slow down. On the gasoline front, we had a drop of 3.65 million. Now that's 6.1 million below the 5-year. It's really closer to about 1.5 to 2 million. And we'll show you why, because that one big spike that you see that normally happened here was in 2020. So if you kind of take that out and streamline it a bit, we're right in line. You can see that there's typically on the 29-year average, you can see that there's that typical kind of drop that happens. Then you flatline, and then you have some of that waffling back and forth as you get into the key demand periods of the summer months. So nothing crazy there. When you look at the what happened around the U.S., Pad 1 continues to be the biggest driver of the shortage. So 820,000 barrel draw from Pad 1 with 8.7 million below the 5-year average. Again, that's kind of that deviation that we keep talking about. Pad 3 is 5.7 million above the 5-year average. So it's those pivot points, but again, still very normal, still where we need to be. We think that this will increase, especially as DISTI becomes the focal point. Imports dropped slightly by 45,000 barrels. That's 290,000 below the 5-year average, with Pad 1 being the biggest drop of 270,000 below the 5-year, and a drop week on week of 61,000. We see that stabilizing and actually increasing as we go into next week. We'll get a little bit of an increase, obviously, because of Easter, pulling some of that forward. But we do see some of those imports accelerating into Pad 1, especially because there is a lot of gasoline in Europe. They're going to try to push it out, and Pad 1 is going to remain that dumping ground. Now, when we look at that average, here you can see that 2020 is that huge spike up. Typically, we have some of that gradual move down, then a bit of a flattening. We see that being very similar. We're right in 2021 level. We expect to follow that 2021 piece, especially when you look at the demand front, where we look at production. It's matching up to be in that kind of that comfort spot. Now, when we start looking at where things are on the survey front, again, the Harris poll shows that 84% of Americans plan to cut back. Again, this is things that we were talking about earlier, but we just wanted to drop it in where it really belongs, because you're seeing the degradation of just people not spending as much as prices continue to go higher. And we want to talk about prices in a minute, but obviously eating out, less driving, not driving to the restaurant, impulse purchases, driving, and flights are the ones that we see as kind of the biggest bellwether. Driving is going to stay fairly stable. The flights front is the one that we see more cancellations, just because prices have gone back up. You're seeing a lot of pressure on just airline ticket costs, and that's going to be the one that's going to have the most pressure points. On the mobility front, as we were saying earlier, we saw China having a big drop. We got that drop, and we don't see that changing in the near term. On the Google mobility front, this is where we saw some of this rolling over. Asia Pacific was down 3%. Globally speaking, we were down 1.4%. Americas, again, that up 1.4, that's kind of right in line with what we normally see with the people starting to creep back up. Typically tomorrow's when you're going to start seeing people leave. Holy Thursday, Good Friday, the market is closed on Friday. You have that 3-day weekend, so we do expect that to move. Apple Mobility driving something very similar when you look at those movements. But China and Asia Pacific are the ones that we see that drop. Remember, Asia Pacific, a lot of them, they do celebrate Ramadan. You do have Easter. So again, you're going to see, you saw that pump. Now you see the fade. And we expect to see that again, that another increase going into the end of the week. And then that drop next week. And then obviously the pick back up as people travel for spring break. But when you look at pricing, this is where we see, so prices fell again on the gasoline front. We're now at $4.08 on a national level, which people see that. You can it's obviously very elevated, still that stable move down. Obviously, crude going back over 103, WTI back over 103, Brent back over 107. It's going to kind of brunt some of that decline. The one that remains the biggest issue is diesel. Diesel just hasn't fallen the same way. It's still over $5. That is what impacts the supply chain, logistics, and cost the most. And in segment 2 of the Econ Show, we're going to discuss more PPI and some of those overhangs. Now, when we look at blending components, when we look at blending components, we're up they had a drop of 3.33 million. When you take it against the 5-year average, it's 0.7 below the 5-year average. But we just wanted to use this chart because you can see that once you take out 2020, it's actually at all-time highs. So 2020 is kind of skewing that instead, and now we're right at where we were in 2017. And we expect this to remain elevated just because, again, that driving just isn't coming through the same way. And that's where we're going to continue to see that remain elevated. Now, when we look at demand and on the crudes, on the gasoline side and kind of broaden that out, you can see that we're right at where we were in 2012, 2013. And the reason why we talk about that is because there's been a steady increase in miles driven almost every year since 2013 up until obviously 2020. So when you look at where we sit on the gasoline front, it's just giving an indication of, people just aren't really driving the same way. And you are getting some of that bite from the inflation front and people trying to avoid driving as much as possible. And here's where, when you look at the workplace front, people, some of that flatlining, we will get that drop as we do have the long weekend, we do have spring break, and that's going to increase parks. But then when you start looking at retail recreation, you're seeing that flatline, and we do expect that to continue to come down a bit as people are spending a bit less given the inflationary push. Apple trends, just showing where we're trending within that kind of normal rally. When you look at 2021, you had that push back up. And again, same thing, your spring, people like to drive. So we are seeing it more. It's just not what is normal in comparison to 2017, 18, and 19. So then when we look at the propane front, we had an increase in a build of 980,000 barrels. That's still 8.2 million below the 5-year average. We're above where we were in 2018, but still at very low levels, as we continue to see exports remaining elevated and local demand remaining strong, with days of supply sitting right at 2018 levels. And those will creep a bit higher and come closer to 2021 numbers, that green line, but again, still at the very low end of the spectrum. And now when we look at jet had a draw of 480,000 barrels. That's 5.4 million below the 5-year average. Jet fuel demand had that spike that we were discussing. Typically you can see that it normally happens looking at 2017, 18, 19. You get that spike and then the fade. Again, airlines are moving product in ahead of the surge for Easter weekend as well as spring break. And then we'll get that drop back down. And that's where we're continuing to see things remain stable, still off of 2019 norms. So again, still lower highs, lower lows. And we expect that to remain the case as we go into the end, pretty much the rest of the year, to be quite honest with you. Now, when we look at the 12-week ahead passengers depart schedule, the number of passenger flights in Russia was down. So when we look at it overall, factoring in China and Russia, the passenger flight schedule for the 12 weeks ahead is 0.9% lower week on week, with cuts remaining minimal. Again, cuts have already happened. If prices keep going up, we could see a little bit more cuts because people are just they're gonna opt out of flying, of traveling. So that's where we could see some of that elevated piece. Now, obviously, as prices go up, you can see that there's still kind of a muted breakdown when you're looking at people going out to dinner. We're still, as we're saying, on the weekends, will be anywhere between 5% to 10% better. Weekdays 0% to 5%. So we're still going to be better than. But again, 2020 was a pretty terrible year, and then 2021 was very low. So again, we're coming off of lower comps, but still an improvement. The question is, how much does this dip, given where prices have gone and how costly it is to go out to eat, which we do expect to see that kind of creep in, especially as prices remain elevated on the food front. So that's what we have here. In the next segment, we're going to start with OPEC and then go a bit more broader into what is happening in the global crude and refined product market.